Topic examines the importance of governance and risk management in controlling credit risk within financial institutions. Effective governance establishes accountability, transparency, and oversight mechanisms that ensure risks are identified and managed appropriately. The board of directors plays a central role by defining the institution's risk appetite, approving risk policies, and monitoring overall performance. Senior management is responsible for implementing these policies and maintaining effective internal controls. Strong governance structures promote disciplined decision-making and align business activities with strategic objectives. Without effective governance, institutions may experience excessive risk-taking, weak controls, and financial instability, particularly during periods of economic stress or market disruption. The topic further explains that credit risk management requires a structured framework integrating policies, procedures, systems, and reporting mechanisms. Financial institutions must establish clear credit approval standards, risk limits, and portfolio monitoring practices to ensure prudent lending decisions. Risk management frameworks should include independent credit review functions, internal audit processes, and escalation procedures for deteriorating exposures. Institutions also need reliable management information systems capable of producing timely and accurate risk reports. Effective communication between business units, risk managers, and senior leadership supports informed decision-making and early identification of emerging threats. A well-designed governance framework strengthens institutional resilience and improves long-term financial sustainability. Another key topic is the concept of risk culture and its influence on organizational behavior. Risk culture reflects the shared values, attitudes, and behaviors that shape how employees perceive and manage risk. Institutions with strong risk cultures encourage ethical conduct, transparency, accountability, and adherence to established risk policies. Compensation structures and performance incentives should align with prudent risk-taking rather than short-term profit maximization. Weak risk cultures often contribute to excessive leverage, poor underwriting standards, and regulatory failures. Financial crises have demonstrated that ineffective governance and misaligned incentives can amplify systemic risks. Therefore, institutions must continuously reinforce a culture that prioritizes responsible risk management practices. Topic also introduces credit risk guidelines designed to ensure consistent and disciplined credit management practices across financial institutions. These guidelines establish standards for evaluating borrowers, approving credit exposures, monitoring portfolios, and controlling concentrations of risk. Financial institutions are expected to perform comprehensive credit analysis that includes borrower financial condition, repayment capacity, collateral quality, industry outlook, and macroeconomic conditions. Credit policies should clearly define approval authorities, exposure limits, and documentation requirements. Institutions must also establish procedures for problem loan identification and recovery management. Consistent adherence to credit risk guidelines improves asset quality, reduces unexpected losses, and enhances confidence among regulators, investors, and market participants. The topic also emphasizes the importance of ongoing monitoring and review in the credit risk management process. Credit quality can change rapidly due to economic downturns, market volatility, or borrower-specific events. Therefore, institutions must continuously assess credit exposures and update risk ratings based on new information. Portfolio diversification is another critical guideline because concentrated exposures to specific industries, regions, or counterparties can magnify losses during adverse conditions. Stress testing and scenario analysis help institutions evaluate portfolio vulnerability under severe economic assumptions. By regularly reviewing credit exposures and monitoring risk concentrations, institutions can identify weaknesses early and take corrective actions before losses become unmanageable. Finally, topics highlight the strong relationship between governance, regulatory expectations, and sound credit risk practices. International regulatory standards, particularly those developed under the Basel framework, require institutions to maintain effective governance systems and comprehensive credit risk management programs. Regulators expect institutions to establish independent oversight functions, maintain adequate capital, and implement transparent reporting processes. Institutions that fail to comply with these expectations may face financial losses, reputational damage, or regulatory penalties. Effective governance combined with robust credit risk guidelines enhances institutional stability, supports sustainable growth, and strengthens the overall financial system by reducing the likelihood of widespread credit failures and systemic crises.